There
Thank you, Rita. Certainly appreciate the opportunity to introduce Joseph Amato. Joe serves as president and chief investment officer of equities for Neuberger Berman Group. He is a member of the firm's board of directors and its audit committee. His responsibilities also include overseeing the firm's fixed income business. Previously, starting in 2006, Joe served as Lehman Brothers Global Head of Asset Management and head of its Neuberger Berman subsidiary. From 1996 through 2006, Joe held senior level positions with Lehman Brothers Capital Markets business, serving as global head of equity research. Joe joined Lehman Brothers in 1994 as head of high yield research. Prior to joining Lehman Brothers, Joe spent 10 years at Kidder Peabody, ultimately as head of high yield research. Joe received his bachelor's degree from Georgetown, class of 1984, and is a member of the university's Board of Regents and the Business School's Board of Advisors. I'm also happy to say he has served many years as co-chair of the Wall Street Alliance. Joe also finds time to be the co-chair of the New York City Board of Advisors of Teach of America, a national nonprofit organization focused on public education reform. Joe and his wife, Lisa, are proud parents of 3 Hoyas, and it is more than a privilege and an honor for me to introduce Joe Amato as our next speaker, a sincere friend. Thank you.
Thank you very much, John.
Thank you so much, John, for the great introduction to Joe here. I'm Rohan Williamson. I'm the professor of finance in the Bolton Sullivan Thomas A. Dean Chair of International Business. Been at Georgetown for over 20 years now. I'm currently the vice provost of education. My areas of specialization are risk management, corporate governance, and firm corporate investment decisions. So really looking forward to this. And again, I want to welcome all of you to the Financial Markets Quality Conference. We were having a great week here and just continue on for the rest of the week. So at that point, we'll just get at it here. I've been knowing Joe for a period of time. So Joe, 2020 has been a really, really exciting year, if you want to state it that way. And so, there's been so many things going on. Let's just think about the past few weeks. I mean, there have been, we have the political situation that's ongoing, some good news on the medical front in terms of coronavirus. And so just kind of looking forward to the next few months, a year, can you give us the Joe Amato view of the markets and the economy, and how do you think things evolving over the next few months or even going into 2021?
Sure. Well, thank you, Rohan, and Rena and the whole Georgetown team for inviting me to be part of your conference. Certainly 2020 has had more excitement than I think we all could have asked for. It was, and remains a quite challenging year for sure. I guess if we break it down, as you reference, Rohan, to the different components, I think on a political development front, which certainly absorbed a lot of the focus in the last number of months, the political result was one that the markets reacted favorably to because of the perceived checks and balances, if you will. The market had some concern about increasing corporate tax rates, which would affect earnings of companies, had some concern about individual tax rates going up, and also some of the spending that was going on, the challenge of paying for that spending. So I think what appears to be control of the Senate by the Republicans, a relatively narrow House controlled by the Democrats, and a Democratic White House, I think, has the checks and balances. And as you saw, the market reacted favorably to that. We'll see if the two sides can reach some common ground. I guess the other major, or the next major development, certainly on the virus and vaccine front, it's a good news, bad news situation where we had amazing results last Monday and yesterday as well out of Moderna and Pfizer with respect to the RNA virus or vaccine developments, which had remarkable levels of efficacy, and the markets appropriately reacted very positively to that. But at the same time, we're seeing pretty scary levels of spike in cases here in the US and certainly Europe. So I think the next month in the U.S. is going to be quite grim. Now, within that backdrop, the economic data has actually been better than expected. So as you look at where the consumer is, certainly helped by the meaningful stimulus packages that were approved back in the spring, the consumer is in relatively good shape because of that income replacement component of stimulus. And some of the industrial numbers and manufacturing numbers are a bit better than what folks have expected. So we do expect the science here to win. And once we get through this near-term spike and the vaccine is more widely distributed, you'll see a more durable recovery. And in that, you'll see cyclical stocks recover probably pretty powerfully. You know, think financials and industrials and energy and materials, which have had a hard time so far this year. And the question in our minds, in which we can talk more about, is what happens after that cyclical bump, return to normalcy, and then after that, the question is, what kind of growth rates do you get?
So, what about a more global perspective? If we think about it around the world, how do you see changes that may impact the U.S. From other countries?
Well, certainly on the health pandemic front, there are other parts of the world, Asia in particular, that seem to have come through this in better shape and frankly handled it more effectively than the Western world, if you will, or Europe and the U.S. So you've seen that China's recovery has taken more, has got more momentum for a couple of quarters now. Even Japan reported the best growth numbers they've had in a long, long time. So that certainly has helped, not having as comprehensive an economic dislocation that Europe and the U.S. have experienced. As it relates to the broader perspective, I think one of the things that we're very focused on is globalization, global trade, and the impact of government policy on that, the impact of some of the COVID impact. For instance, we see businesses bringing their supply chains closer to home because of global trade wars that were occurring and still are occurring in the case of China and in other countries, and also the stability of that supply chain in the context of a global pandemic. So that's going to have some impact on the reversing to a certain degree the trends of globalization. But I do think ultimately that I don't know if this is the right analogy, but the genie's out of the bottle for globalization. I mean, you're not going to be able to reverse that in any meaningful way, but on the margin, I think we do see a net element of recession, if you will, in global activity. I don't mean economic recession, but receding levels of global engagement.
So as we look back on 2020, and you alluded to that earlier, so there have been challenges, obviously the main one being the pandemic, but specifically social justice issues in the U.S. And both of these have consequences, I think, for ESG, where you guys have been providing a lot of leadership. And ESG investing seems to be gaining a lot of steam. So where do you see the growing interest coming from?
Well, maybe I'll start, Rohan, with how at least we define the broad world of ESG. So we think of it as a spectrum that runs from exclusion investing, if I were to call it that. So you're in some cases we manage money for clients that want us to exclude certain types of businesses. Think, in their definition of bad actors, right? Whether it's defense companies, weapons manufacturers, or a whole host of different things, right? So that is within the spectrum of broadly defined ESG. That's a decreasing segment, though. And then you have in the middle the incorporation of material environmental, social, and governance factors in the investment process, right? So that's the bulk of the investment world right now. To varying degrees are incorporating, and for us, materiality is the key word there. We care a lot more. What's a good example? We care a lot more about a bank's financial institutions' fair lending practices than we do about how many solar roofs they may have on their bank branches, right? Some may care about that, right? That may be important for certain of their customer base, but in terms of the factors we would incorporate more deeply would be their fair lending practices in the context of, that would be an S factor, if you will. And that's, as we've seen, gotten a number of financial institutions into some trouble. And then on the far end of the spectrum is impact investing. And that is where you're seeking outcomes in addition to the pure arithmetic outcome of that financial investment. So whether it's related to the Sustainable Development Goals that the UN has published, whether it's things like reducing poverty, enhancing healthcare outcomes, the environment, et cetera. So that whole spectrum is how we would define ESG. The bulk of strategies in the middle. To your question of where the demand, so we have, I would say 5-7 years ago, the demand was primarily out of Europe and I would say Northern Europe in particular. And over the course of the last number of years, we've seen a rapid change in that. Asian investors, where ESG wasn't a primary focus, has changed dramatically. In North America, probably US in particular, was pretty far behind our European clients, and that has changed rapidly, right? So it's a deep topic that is across the spectrum of individual investors as well as large institutions.
So if you look forward here to the future, how do you see investors leaning into ESG, and also even from a firm standpoint, how are firms reacting to it? Are they really reacting to ESG in material ways, or they just continue to do what they've been doing and the investors are picking firms?
I think the industry, the asset management industry broadly defined, I think has really embraced ESG, and in some respects for the simple reason that our clients care about it. We certainly have our own passions about different components of ESG, but our clients care about it. And we do believe, I should have mentioned this earlier, we do believe that material ESG factors can enhance return and help you manage risk. So it's not just about optics. It's not just about what sounds good. It's not just, about what clients want to hear about. It's actually enhances your ability to manage your investment portfolios. So I think because of that, it's going to continue to gain, I think, meaningful ground in the investment community. Where impact investing goes is an open question for sure, because there is a perception that impact investing entails or results in a bit of a trade-off with return. And those who have fiduciary responsibilities, think pension plans or endowments or what have you, are in fact required to maximize that return. So that trade-off is something that is going to be interesting to see how that develops. Certainly for individual investors, where they don't have the formal fiduciary responsibility, they're investing in ways that are very much part of their own passion. And we've seen a meaningful pickup in interest in impact strategies. And I think the COVID experience, which laid bare many, many challenges in our society, inequality in a whole host of different ways, economic opportunity, income, healthcare access, educational access, social justice system, are areas that I think impact investing is going to play a really important role. And certainly some of those issues are absolutely incorporated into the core ESG as well.
So just to kind of talk a little bit more about that. So we've seen COVID, we've seen, and there's been a lot of conversation related to inequities and racial justice. has this sort of changed the discussion? Is it advancing the discussion? How has these mainly those two issues changed the way we think about ESG?
Well, I think it's in some respects been part of the core ESG calculus, if you want to call it that. We'll take an example, diversity. So the diversity of workforces and boards have always been a very important material ESG factor as we've looked at the G, if you will, governance, and also the S, if you will, around workforce. So that has very much been part of that equation, engaging companies, pushing companies to release more data on the diversity of their workforce, pushing companies to increase the diversity of their board. So that's an example where things I would say certainly accelerated. I think many companies who may have been to put it politely, maybe a bit late to the ESG and social justice mindset have been pushed by their customers, pushed by their own employees, and by the investment community as well. So I think it's an issue that I'm hoping has some durability to it. I expect it will have real durability to it. You never like to see a spurt of engagement like this and then peter out over time, because you really do want to see sustainable and durable change, which takes a lot of time. I mean, the changing a board of directors, for instance, doesn't happen overnight. Changing the profile of your workforce doesn't happen overnight. So, those are I think one example of how ESG plays into some of the issues that we all, we're thinking about, talking about, and engaged with over the course of the spring and summer, and hopefully well beyond.
So, related to the social justice component, there's been a lot more discussion now about inequality, right? And we know over time, the idea is during a recessionary periods that things like inequality sort of gets worse. But being engaged and you've been involved in the stock market for a while now. Is the stock market a part of the problem or part of the solution to wealth inequality?
Well, I think it's both. So I think that the narrowness of the population that owns stocks is way too small, narrow, few, however you want to describe it. So when those individuals that have exposure to, let's just say, a very simple S&P 500 ETF are sitting here today and have seen their portfolio go up by 12%, which is pretty remarkable when you think about the economic dislocation that we've seen occurring in so many different parts of the global economy, and certainly the U.S. Here. So that narrowness is a real issue, because there's a lot of folks left behind in terms of that opportunity to build wealth, which the equity markets and financial assets in general represent. So as much as the Fed certainly has appropriately positive intentions to help with the economic decline by fueling markets with a tremendous amount of liquidity, that has served to inflate, in some respects, if not many respects, financial assets, when there's still parts of the economy that are left behind. So, in that sense, it's been a challenge. Now, the opportunity sense is we could broaden out ownership, whether it be through savings, pension plans, greater participation in investing, greater education in developing savings, right? There's a major savings problem in the country. So if we can figure out ways to enhance that, then broader segments of the population, if you will, can participate in the long-term growth that equity markets represent, right? As often my colleagues here remind me, you know, equity markets go up 80% of the time. You look back over the last, whatever, 80, 100 years. So not having that level of exposure has been a real issue. And one of the things, and this is maybe more than the specific question you asked, but one of the things I really worry about, so my earlier response to your question around kind of the near term, we do expect the cyclical recovery to take hold. Once that spurt occurs and we get back to normalcy, I really worry about the environment that the economy and for that matter markets are going to be faced with. So in a world of secular stagnation, which is kind of a, you know, trite term a bit, but think, you know, low inflation, low rates, low returns. In that world, and with an economy that is, I worry and expect, is going to be grinding out growth in the 1.5% to 2% range. So I think real GDP in the US in that range, right? That's a really challenging dynamic for dealing with income inequality and economic opportunity inequality that exists today. You know, one of the things that's really helped as we've seen economic data across the world, whether it's China or whether it's in the US, accelerating economic growth helps to narrow income inequality. And so, you know, the leaders of the US, the leaders of the world for that matter, need to figure out policies that can help enhance global growth, enhance global productivity, because that will have a benefit of chipping away at the core problem. The problem can be dealt with in many additional ways, education and et cetera, which we probably don't have time on this call to discuss, but certainly as it relates to economics, I think, you know, greater economic growth is important. And if you're grinding it out at 1.5% to 2%, I do fear for that world. And, you know, we'll see. I hope I'm wrong, but we'll see.
And just to tie it in further, if you think about COVID and you think about, you mentioned the stock market doing very well. And then we look at unemployment rates and that increasing and job loss during the pandemic. Has it made things worse? And within that, this disconnect that we see between the stock market and sort of the real economy and Wall Street versus Main Street sort of differences. And so how do you think about that? Is this making this worse, or how do we want to think about the dichotomy that's going on here between the stock market and say the real economy?
So there is certainly on the surface a very, very big disconnect of certain segments of the equity market and what we're seeing in the real economy. You know, one of the things we talked about back in the spring, and we wrote about here at Neuberger is, you know, this was going to be a different kind of economic dislocation. It was going to be much more painful on small business than past economic recessions. And I think has certainly proved to be the case. So, you know, that dislocation on the surface is a little bit misleading because, you know, if you look at the S&P 500, which is the market everyone references, that's really a growth stock index. I mean, the S&P 500 is really not reflective of the economy. So if you look at the digital transformation, some of the economic trends that were accelerated by COVID, many of those companies benefited from that, and many of them are very, very large components of the S&P 500. So if you look at broader measures of the market, if you look at value indices, indices that reflect, you know, as I think I referenced before, financials and industrials and, you know, energy and materials, et cetera, more of the, I guess what we might call the real economy, you know, those indices have had a really tough time this year. So that disparity in returns is quite dramatic. It's not necessarily illogical when you look at the components of growth stock indices that have done very well, right? Like good or bad, like it or not, Amazon.com benefited tremendously from this environment, and that stock is up significantly this year, right? So you're going to, you know, have those disparities in any environment. But the worry is that small businesses have been dramatically impacted. There are lots of bankruptcies. There's some industries that have been absolutely decimated. When you think about, restaurants and leisure activities, anything where obviously people are gathering, have been absolutely decimated. And, it's important for policymakers to deal with that. So the Fed, for instance, has devoted a significant amount of money, like in the hundreds of billions, to get to small business, but they've set such high bar in getting access to those funds. Those funds haven't flowed to those small businesses. So hopefully the Biden administration and the Fed will adjust that so that money gets flowing into the parts of the economy that are still really suffering.
So, and let's take that a little further here. We see the central bank, they've taken action. We see really low interest rates and some desire for some, even from Congress, for some sort of stimulus. So in sort of the near future and going into 2021, what do you see as the role of the central bank in dealing with this? And what would you like to see? What do you think will be more effective role for the central bank in dealing with this recessionary period?
So I think I don't envy Chairman Powell. He had a quite a tough job. I think what the Fed did was absolutely necessary and had remarkable positive impact in many, many different aspects of the economy. Not every aspect, as I just referenced. The speed at which the response occurred back in the spring, if you think back to 2008-9, financial crisis, back started, well, way before the bankruptcies in September of 2008. And having been at Lehman and Neuberger, I remember that all too well. I remember it like, my worst root canal. It wasn't until October, November, I think it was October, when TARP was passed that helped provide some stability to the banking system. And you didn't have an economic stimulus package until April of 2009, which is about $800 billion, if I remember correctly. So think about how that was all compressed in a matter of weeks when we go back to the March, April timeframe. So Congress moved remarkably quickly. Crises tend to do that. And the Fed moved very quickly in providing liquidity to enhance the functioning of financial markets, right? We were most worried about, it wasn't the equity markets, despite a meaningful drawdown. That's equities. They decline when economic recessions occur. But it was really the fixed income markets that had a frightening level of lack of liquidity, even in government securities markets, which are the most liquid markets in the world, right? So the Fed had to come in to ensure that credit continued to flow, and that's been, I think, a positive and remarkable development. But the Fed is limited in its toolbox right now, right? With rates where they are, some of the actions that they took back in the spring and over the course of the subsequent months, limit their ability to deal with some of the challenges that I referenced earlier, right? Secular stagnation for the Fed. If you're keeping inflation rates down, that's almost all the Fed can do. So you have to combine that with elements of the fiscal side to develop policies that are going to have a more constructive effect. So when you think about stimulus, so lots of debate about stimulus. We think of stimulus in two ways. One, there's sort of income replacement, which for folks who are out of a job, enormously important, and that got done and needs to get done, some additional stimulus. But you also need things like infrastructure investment that can enhance productivity. If it's just income replacement, then at some point that will go away as jobs recover or what have you. And the underlying US economy needs to enhance its level of efficiency and productivity. And you need to have smart investment programs to do that. And I haven't really seen that out of, unfortunately, out of Washington in a long, long time. So that's going to be one of the major tasks of the Biden administration.
One of the last questions here. So one outcome of the pandemic, so you see a lot of thousands of new smaller investors that are investing as day traders, right? So, and they're using every platform, fintech and traditional platform, and they're utilizing a lot of market incentives, for instance, trading fractional shares. How do you see this over the short, medium, and long term? Is this something you think will continue, or is this just a pandemic thing where more people are at home and looking at their computers and wanting to do this?
I think that broadening out investor participation, I think, is a good thing. To the discussion, we had a bit earlier, having folks more knowledgeable about how capital is allocated, how financial markets work, hopefully promoting a level of savings and investment for the future, are all things that I think are very positive and hopefully have some sustainability and some durability to those trends. I do worry that there has been a lot of I'm going to be polite when I say a lot of speculation, a lot of momentum trading, a lot of things that as many of our folks listening in probably have seen before, and I fear a lot of that's going to end in tears. I encourage folks all the time, of course, to be knowledgeable, to invest, to learn investing when they're young, sharpen their skills on that. But some of the speculative activity that we've seen over the course of the last 6-9 months feels like an intense level of just raw, speculation on how to make a quick buck. And I'm been around long enough to have seen how that ended in 2000, 2001, when a lot of this type of activity was going on in tech stocks, and some of it goes on today. A lot of it goes on today in tech stocks. That ended in lots of tears. So I don't think we see the excessive valuations of the tech bubble by any means. We see it in some segments of the equity markets, but not as broadly as we saw it back in 2000. But individual investor behavior, I've seen on the margin, on some modest segment of it is a bit worrisome.
So Joe, I think we're running out of time here. So I'll leave the last word up to you. Any type of it, at least for our young participants, any words or anything you would say in closing to those guys in terms of careers, or any wisdom you would like to pass on, given your extensive experience and the success you had in your career?
Yeah, I caught the end of Barbara Novak's comments, who I know Barbara for a long time, and I'm not going to outdo her, I'm sure, in her perspective. But my thoughts are appreciate your alma mater, support your alma mater. Georgetown, for me, transformed my life. Relationships I built at the time and through connectivity with Georgetown over the many years since I graduated are some of the most important and durable that I've had. So, value that tremendously, and also give back. Giving back is an important component of all of our careers, right? If you, many people choose a career in business but still have lots of desire to have positive impact on different areas of society. And you can absolutely do both, right? I serve on multiple nonprofits and feel like that's the most fulfilling part of the things I've done, whether it's helping Georgetown or, education reform movements, or what have you. So give back, certainly work hard, be nice, give back is, I would say, 3 things that jump off the top of my head that what 2 cents of advice I can provide.
Well, again, Joe, thank you so much. You're contribution across all dimensions to university and your commitment to what we're doing here. It's just greatly appreciated, and over your wonderful career. Congratulating you on that, and I hope you will continue to do so, and we look forward to you participating, not just in this type of event, but continue to be engaged with Georgetown, and just look forward to working with you.
Thank you, Ryan.
Thank you.
Thanks, Rohan. Thanks, Joe. So let me close out today's event now. So when we asked our speakers and we asked our panelists and put this conference together, we said that we want to discuss the future of global finance and addressing societal changes. And I do not think we could have gotten better insights than we did from Henry Fernandez of MSCI, Barbara Novick of BlackRock, and Joe Amato of Neuberger Berman. Huge global firms in financial services, but I think the insights that they shared with us were absolutely thoughtful and important, and I think very extremely valuable. So I can't thank them enough for what they did today. And again, tune in tomorrow. We've got markets on Thursday. Tomorrow we've got Thursday is fintech and digital assets, and Friday is the election, politics, policy, and regulation. So we'll see everyone right here tomorrow. Thank you very much.